Hello, everyone. Thank you for joining us today. We are more than honored to be sitting down with Mike Zaccardi, an investment writer and analyst. Thank you so much, Mike, for joining us today.
My pleasure, Justin. Thank you.
Mike, there's a lot going on right now in the world. What are you keeping an eye on most on the economic front?
Yeah, well, all eyes are on the Fed, and as they begin their tapering process, which they announced earlier this week. So that's really driving the macro picture for the global markets. We're in this environment right now where many emerging economies are really being forced to raise their policy rates. It's something that I've talked about at pretty good detail over at Top Down Charts, where I write with Callum Thomas. And so we're seeing this liftoff in policy rates across the emerging economies, and now that's kind of progressing its way into the developed nations. So, we're not there yet in the United States. The Fed obviously has not hiked rates, but the market is beginning to price in the likelihood for an increase in the Fed funds target rates, towards the middle of next year. So we'll see how the market handles that. Financial markets, the one thing they really don't like is uncertainty. As long as there's good signaling about what the Fed will be doing, the markets should be able to take that in stride. But looking at price action this week, obviously stocks hitting all-time highs across the U.S. markets, and we have foreign shares really off the highs, at least underperforming significantly versus U.S. markets, as money continues to flow into many of the big tech companies. So we're seeing kind of just more of the same that we've seen over the last 6 months or so. So a lot going on, a lot of things to watch here into year end. And the macro picture is certainly in flux and will be something to keep an eye on for sure.
I'm looking at a Economist article from this morning, and it reads, in recent months, the world economy has come to resemble a badly microwaved dinner, generally hot, but with some bits of merely lukewarm and others positively scorching. Consumer prices globally are likely to rise by upwards of 5% this year, according to the IMF, which would be the fastest increase since 2007. But price rises in emerging markets are running ahead of those in the rich world, and a few unfortunates, such as Argentina, Brazil, and Turkey, are feeling particular pain. Their experience helps illustrate how and when inflation can get out of hand. And I think the point of this article is that this, like you mentioned, is perhaps creeping towards the industrialized nations, right?
Yeah, yeah, it's very important to see what's happening in places like Brazil and Turkey. The Brazil central bankers have increased their policy rates substantially over the last several months, and that's caused extreme volatility and, frankly, downward price action in the Bovespa index and the EWZ Brazil ETF. That's been one of the worst performers over the last 6 months across the world. And then you can look at Turkey. We have the Turkish lira continuing to depreciate versus the US dollar. So, I mean, there's a lot of turmoil that's going on around the world as the US economy continues to run very strongly, even with some inflation fears going on. The bifurcation right now, I think, uh, between the US market and the rest of the world, to me, it's it's at one of the more extreme levels that I've seen in covering financial markets over the past 15 years.
How did 2020 change the nature of financial markets and what you're looking at generally?
Yeah, I mean, obviously 2020 had so many, unprecedented outcomes, but it just further cemented the positioning of big US companies and their dominance. You can look at it from two perspectives. We've got US versus international. The US economy took a lot of measures to combat the economic impacts from the pandemic, both on the monetary side and on the fiscal side, something we really hadn't seen in uh, ever for the most part. During the great financial crisis in '08, we had an immense monetary response, but the fiscal response wasn't a ton. We had some bailouts, but those didn't amount to really a whole lot of stimulus relative to what we've seen over the last 18 months in the United States. So the US economy took these measures in 2020, and it really lifted us up above the rest of the world. And then within the US, it's kind of interesting too. This is point two. We've seen the big dominant companies become more dominant. So those companies that were positioned well going into the pandemic have just eaten up more and more market share. And some folks will call that kind of a red flag because they say um, the big companies have dominated, and a lot of people are waiting to see if small companies can come back and play catch up.
Are you anticipating that they will be able to, or won't they be able to?
It's a good question. No one knows. It's really a crystal ball type of thing. What's interesting is we had that short time frame that really began about a year ago that lasted roughly 4 to 6 months, where small cap U.S. stocks performed very well. Cyclicals performed very well. Value stocks did really well. But then, once again, starting in about you could call it March, April, May, that time frame, large cap growth stocks came back and they once again proved their dominance. So a couple of things that I'll be watching. I want to see how the tech sector versus the S&P 500 does. Right now, it has not quite broken out, but it's getting very close. So the relative chart of the tech sector versus the S&P is something to keep an eye on. Also, the relative performance of small caps versus large caps will be an important chart going forward as well. That still has some work to do to really prove itself as a breakout, but those are two charts that I think traders should have on their radars.
I speak to a lot of analysts who say because of the easy money environment, they're expecting the stock market to keep on going up until the Fed changes its policy. Is that your feeling?
Well, that's another one that's always tough to kind of figure out. To me, I think it comes down to how well the Fed signals what they're going to do to the market. You can look back to 2013 and when the Fed did that taper of asset purchases, and then when the Fed raised rates in 2018. So looking back on those periods, there was a very short period of volatility in 2013, mainly in the bond market. The stock market handled it with gusto. The S&P 500 surged in 2013. And then 2018 was an interesting year because we had a run up in stocks up until the fourth quarter. And then we saw an immense amount of volatility and downward price action in the fourth quarter as the Fed kind of finished up that tightening period, if I recall. So bottom line there is, I think the Fed has to signal to the market that what they're going to do ends up happening. But it's very difficult to determine, how the equity markets and bond markets really digest all of that as it's happening.
What have you thought the result of Fed policy over the last, 18 months has been on either markets or the economy generally?
Well, I think some of the moves that were made in March and April of 2020 kind of changed the ballgame quite a bit. Namely, when the Fed stepped in to purchase high yield junk debt. I mean, that's something that people were really not expecting. And that may have been the ultimate boost of confidence that the Fed is going to do whatever it takes, to quote the European central bank's terminology from about a decade ago. The Fed would do whatever it would take to stabilize financial markets. So the Fed stepping in, buying corporate bonds, may have changed the landscape in terms of the risk profile of corporate debt going forward. So over the last 18 to 24 months, I think that move in particular was a game changer. You know, everyone talks about the huge expansion of the Fed's balance sheet up in excess of $8 trillion now. That's a big number, but you know, it's always gone up. The Fed has always been expanding their balance sheet to try and control economic outcomes. But important signaling devices like buying corporate bonds, to me, may be a more important move. And it introduces, you know, a different risk return profile for the fixed income world going forward, I think.
What kind of world do you think that portends for the fixed income world?
Well, I think we see it right now. We see corporate bonds pretty much near all-time lows in their current yield to maturity. High yield bonds were for a time below 4% on the U.S. high yield index yield to maturity. So yields are just so depressed right now. And what's interesting is in the textbooks, it would say that one of the factors that encompasses or makes up the yield on fixed income securities is an inflation premium. But then you look at the inflation rate and the current yield to maturity across the fixed income space, it's not there. So it's almost like there's no inflation premium anymore in traditional types of fixed income assets. And you know, it's almost as if the aggregate bond index, you know, AGG can be the ticker there. It's seen now as almost like having a crash risk premium. What I mean by that is safety securities like treasuries are now seen as such an important asset if there's ever a stock market crash, dip, bear market, whatever you want to call it, that is keeping yields so low. So people are willing to buy bonds with an interest rate below inflation, way below inflation, because they see that as such a safety security if there is some kind of stock market event. And Jeremy Siegel has talked about that a little bit. And to me, that thesis makes sense based on the price action and current yields that you see out there.
Are you keeping any, are you keeping a pulse on the VIX at all? And how has that been behaving? And what are you seeing now?
Yeah, so just earlier today, we had the VIX touch new 52-week lows, I think, under 15. You can look at the term structure of the VIX. I haven't taken a look too recently on the VIX forward curve, but I haven't seen any red flags that indicate specific event risk coming up. So the VIX is below its historical average. You know, it tends to be 18 to 20 is the long-term average of the VIX, and you know, we're around 15 right now. It's been higher than it was in 2017, which was a kind of a comparable year in the stock market. And I think the VIX is running a little bit higher than what you might expect, because it's the market today, the S&P 500 is more concentrated in specific industries and sectors versus 2017. So it's essentially you have maybe 15% of the S&P 500's market cap in a handful of stocks that trade very similarly. So I guess you could say it's less diversified, and that's why implied volatility, is maybe a little bit higher than what you might expect given the strength of the market this year. You know, back in 2017, the VIX really was coasting in the low teens, whereas this year it's been mid to upper teens. So to me, that's not a major red flag. Typically, stock market returns are pretty good when the VIX is in this mid-teens range. It's when the VIX is hovering in the low to mid-20s that you see market returns going forward get shaky. So, you know, if anything, right now the VIX tells me that, you know, the next 3 to 6 months could be a pretty decent period for the bulls.
Huh. Even with tapering.
Yeah, you know, the Fed has signaled pretty well what they're going to do. And so far, everything's on course. So I think the market has digested that well. And that's been factored into asset pricing to a pretty good extent right now. There's been no bad surprises. If the Fed were to do something or really drastically change their language in a way that the market didn't see coming, that would be bad. But so far, everything is kind of steady as she goes on the Fed's tapering plans, it would appear.
For those who don't know, what is the VIX, the volatility index?
Yeah, so the volatility index is basically an implied volatility measure of the S&P 500. So what it does is it looks at the puts and the calls 30 days ahead in the S&P 500. And with that, it then annualizes the volatility to give you a reading of expected stock market moves. So to put some numbers to that, if the VIX is at 15, which is about where it is now, that implies a daily move in the S&P 500 of about 1% up or down. You know, back in 2008 and then in March 2020, it got above 80. And that implied a daily move of, I think, about 8% up or down. The low end of the VIX gets to be about 9 or 10, with the daily move implied of just 0.6 or 0.7%. So the higher the VIX goes, the more traders are thinking that the S&P 500 is going to move around a lot. So it's just that annualized measure of expected moves in the S&P 500 over the next 30 days.
Are there any other technical indicators or charts that you like to look at in particular?
I like to monitor what's happening between small caps, large caps, which I've talked about a bit. Also, what's going on in the US market versus ex-US stocks. And then being a chartered market technician, I'm always paying attention to kind of broad movements in a few different asset classes: stocks, bonds, commodities, and currencies. So how all of those are moving with one another, how the correlations are kind of transpiring, is always something that's of interest to me. You can take a day like today, for example, where we have the US dollar is higher. Gold prices are higher, though, which is unusual. So typically, gold will trade up when the dollar is down. But today is kind of an outlier. It's a different mix where people are buying gold while the dollar is up. What that tells me is, well, maybe there's something going on in the gold market that we should be paying attention to. If we do see a decline in the dollar going forward, maybe that's even more kind of bullish fuel for the gold market. So I'm always paying attention to that intermarket analysis, as we technicians like to call it, to just get a pulse of what all the various market traders are thinking and what they're doing with their money.
What are the steps to your intermarket analysis? So when you wake up and you want to get a pulse on how everything's going, what are you looking at first and second, et cetera? So you are actually on mute. So, or actually, I can't hear you. So,
It looks like my internet is picking up here.
oh yeah, it's no problem.
Okay, I can hear you now.
Cool. Yeah. So, I'll ask again. So, where does your intermarket analysis generally begin, and where does it end?
Yeah, so I follow that old CMT curriculum of stocks, bonds, commodities, currencies. So, to me, I don't have, maybe I first look at what the stock market is doing and then look for drivers of that. But I don't have a set process of what to look at first, because you always have to be flexible. Correlations change over time, and what worked, back in 2008 may not work now. Even what was working 2 years ago may not work now. A great example, I think, is looking at what was happening among discretionary stocks and the energy sector. In October, the two best performing sector ETFs were discretionary was the top, and then energy was the second best, which is historically, that doesn't make any sense because historically, when oil prices were up and energy companies were trading higher, that meant bad things for the consumer. So consumer discretionary stocks would typically get sold off in that environment. But it's a little bit of a different world today. If you look at the discretionary ETF, the two main stocks there are Amazon, which you could argue actually may benefit when oil prices go up because people are less likely to hop in their car and drive to buy something. They'll just go online. And then Tesla. And Tesla isn't like your traditional automaker, right? It's more involved in EVs and the future of energy. So when oil prices go up, it essentially makes the value proposition of Tesla's technologies and their EVs more valuable. So that's an example of a correlation that may have worked in the mid 2000s, which is different today. So to answer the question, I don't have a set process. I just look for these interesting changes in the market and go from there to try and find what the drivers are of those changes.
Does this analysis work in the crypto markets? And if so, how do you apply it? And then if not, what other techniques do you apply to the crypto markets?
Yeah, so I think you can apply similar analytical methods to the crypto market that you do in the stock market, because the crypto space, it's dominated by Bitcoin and Ethereum right now, but then you've got others, and there's a whole host of other cryptocurrencies and other coins out there that you could say are just like the new stocks out there. So a couple of the things that I look at, I like to keep an eye on what the total market cap of the crypto universe is. Currently it's about $2.7 trillion, which only represents about 1 to 2% of the global investable universe. So it's not much yet. I don't know how big it's going to get, but $2.7 trillion sounds like a lot. But then when you put it in perspective of the global equity market, which is probably about 140 trillion now, and the global bond market, which is maybe 125 trillion, it's still pretty small. So I like to look at the total market cap of crypto, 2.7 trillion, and then the market cap of crypto X Bitcoin. So what are all the others doing? You take out Bitcoin, and now we're looking at about maybe 1.5 trillion thereabout. And you can also take out Ethereum. So the market cap of crypto, taking out Bitcoin, taking out Ethereum, and that just crossed $1 trillion. So there's actually a pretty sizable chunk of the crypto universe that's being held outside of the main assets, Bitcoin and Ethereum. So you can perform relative strength analysis on one token versus another to see what might be breaking out. And the thing is, when those moves happen in the crypto space, liquidity is somewhat thin in a lot of those other coins. When you see a breakout take place in one of those smaller coins, it just gets nuts in terms of the move that you can see. So you can definitely apply a lot of the same charting methods that you do for individual stocks to the crypto world for sure.
And then I want to hone in on Bitcoin. I noticed that there's actually a little bit of a division between the Bitcoin industry and the crypto industry. In fact, even some animosity between the two. I'm curious, in terms of the Bitcoin market, how long have you been keeping an eye on it? How is it a novel market, and any other macro observations about the Bitcoin market? And then I'm curious, kind of, what do you think is going on there today?
Yeah, being more of a technician, I don't really pay a whole lot of attention to the fundamental factors of Bitcoin. For example, understanding all the protocols and the use cases. But I think you can look at price action to get a sense of the fundamentals that are going on out there. So Bitcoin right now, it's still in the low 60s. All-time high was made a couple of weeks ago around 65, which essentially just matched the high from the spring. So Bitcoin has actually done a whole lot of nothing over the last 4, 5, 6 months back from that Q2 peak. So Bitcoin can be seen, I think, as obviously the initial coin that came about. It's almost like the blue chip cryptocurrency right now. And some people would say that other tokens like Ethereum may have more use cases. And you see that, I think, in the transaction data. In order to purchase a lot of NFTs and things of that nature, you have to spend Ethereum to do that, whereas Bitcoin isn't the default. So I don't know. Bitcoin could be seen as more the legacy asset. Still it's the biggest one by market cap, but Ethereum has outperformed Bitcoin over many time frames now. So it may have a little more momentum in that space. So maybe the older crowd is in Bitcoin, the newer crowd maybe in Ethereum and some of the other ones. But that can always change. Price often changes the narrative rather quickly. So who knows? We could see Bitcoin rip higher to 100,000 while Ethereum stays put. And then suddenly everyone is saying, oh, Bitcoin is the dominant one and always will be. So you just always have to be mindful that price drives narrative in most of these markets, and not to, I guess, get married to a single narrative or position, especially in the crypto world where things are changing all the time.
I suppose one attribute of Bitcoin is that there is quite a bit of transparent data that you're able to look at. There's perhaps also some unique angles of analysis as well. For instance, I believe Jack Dorsey was able to essentially call a Bitcoin price a few months out via the block number. So he picked a block number, which are the mechanisms through which Bitcoins are produced or released, and he picked the price there. So I wonder if there's some price shops that are doing block-based price analysis. I need to look a little closer into that, but there is at least a transparent sets of data, and I think probably some unique analysis going on, particularly behind the scenes at some of these shops. So go ahead.
Yeah, I mean, I would imagine the smartest hedge fund guys out there and so many PhDs and engineers are active in this space, which makes it kind of tough for the everyday investor, where you're kind of going up against these people who are super smart. So maybe one of the best tools you can use are charts and understanding all of the fundamental factors that go into crypto. I know I'm not smart enough to do that, but I can read price action and see what's in favor and what's not. And for most traders and investors, that may be their best, their better option. Because yeah, like you said, there's shops out there who are likely devoting a lot of time and resources and money to doing things like arbitrage and figuring out what intrinsic value of these things may be.
Looking at the gold market, so you mentioned that it was up, although the dollar was up as well. I see also you tweeted that it was consolidating. Could you kind of explain the price action we've seen in gold this week and today?
Yeah, near term, the gold market is just not that exciting. It's over the last several months, it's been rather flat. There's been some hiccups this week and interesting price action this week, but gold in general just is not a very exciting chart. We're seeing a consolidation in price action, so there's no real clear trend. On a long-term basis, it's kind of matching its highs from back in 2011. So, we really have to see if this thing breaks out or breaks down. I'm looking at the chart going back to the summer of 2020, and in general, we see higher, lower highs and some higher lows. So it's coiling up, and a technician would look at that chart and kind of step to the sidelines and wait for a breakout or a breakdown. If we fall below the 1670 area, that could definitely have some bearish implications. But if we break out above, say, 1920, that could be a bullish sign. So to me, what's most interesting about gold is how volatility has really dropped and prices are coiling up like a spring. Technicians like to see that coiling up price action for a potential move up or down in either direction. And it's until we see that move um, before we actually make a trade. So a technician would like to see that breakout or breakdown in the gold market. So, there's been some interesting action this week, but to me, more has to take place for evidence of a trend establishing.
Is similar happening in the silver market, or do you see anything differently there?
Yeah, let me pull up the chart of silver to see what we can glean from that. So you can take a look at silver futures, or you can take a look at SLV, the ETF that tracks silver. And similar to gold, it's been a huge underperformer this year and over the last 52 weeks. I think the chart of silver is a little bit interesting going back a few months. We had a low put in late September. I'm looking at SLV right now at about 20, and then it rebounded to just shy of 23, and now we've pulled back to 22. If it can get above that 23 level, that definitely starts to look interesting from a bullish perspective. But if we break down below, we'll call it 20 to 21, that's going to bring about another wave of selling. So to me, the pressure is on the bulls here to bring the chart of both silver and gold to the upside, because they've been such huge underperformers over so many time frames. So, my natural inclination is always somewhat bearish on these precious metals. They really have to prove themselves before things turn around in a bullish fashion.
When you see something underperform for so long, does it bring up any other factors in your analysis or your considerations?
Not a whole lot. I mean, the longer something is a relative loser, the more it's kind of drops off the radar, I guess, because it becomes a smaller piece of the investable market. So, it's all about your time frame. I think for a lot of traders, establishing what your preferred time frame is maybe one of the most important things to determining your risk management. So if you're looking at a 10-year chart and something that's gone just straight down, you really need to see a lot of improvement in the chart to turn bullish. You don't want to be just trying to pick bottoms. As technicians have a lot of phrases that we like to use, and we one thing we say is picking bottoms leads to stinky fingers. So that's kind of what you see when you try and call a top or a bottom. So you really have to look for evidence that a trend has changed before you look for that inflection on a chart. So that's a high level rule of thumb, I think. Something more tangible, I think, is when something has been in a long downtrend, for example, it makes it difficult for it to recover, because as it starts to go up in price, you start to encounter a lot of overhead supply from people who had bought in hoping for a rebound, and now they're looking to sell just to get back to even. So it kind of plays into traders' behavioral biases. We tend to anchor to the purchase price, and when it drops down, we don't want to sell. We're loss averse. But when that stock price comes back up to where we bought it at, we're more likely to sell to get back to even, because we don't kind of register that as a loss in our brain. So that's something that you also have to be mindful of, is when something has been in a downtrend for so long, it's going to take something really big to turn that around in a big way, simply because of our behavioral biases.
As a technician, before you make an investment, what do you like to see line up?
Well, I tend to be a bit of a longer term investor. So I don't do a whole lot of short term trading, to be honest. To me, I always want to manage my risk appropriately. So I'm not much of a speculative type of investor. I look for just long term, evidence based returns and assets that will grow wealth more slowly over time. That's just my take, because I know myself. My biases tend to get the best of me when when I do some short-term trading. So to me, I just look to manage risk where I can. If you're buying an individual stock, for example, uh, doing something like rebalancing into a losing position can be dangerous because an individual stock can go to zero. If you start rebalancing your portfolio, taking away from your winners, adding to your losers of individual stocks, well, you run the risk of ruin if one of your stocks just happens to go to zero. So that's just one thing from a portfolio perspective that investors and traders should be aware of when they're trading individual stocks, um, as opposed to ETFs and broad-based funds. So that's one thing that I am always cautious to do when I'm doing my rebalancing, things like that is, for any individual stocks that I may own, um, I'm mindful to recognize that a single stock can always go to zero.
Are there any other tools that you like to use? For instance, you mentioned in the gold, you've seen it kind of coiling up here. Can you explain that phenomenon? And then also um, how one might determine whether the stock's going to go up or down, or at what point have you seen a new trend be reestablished once you've seen that coiling?
Yeah, so the coiling price action is simply lower highs, higher lows, and it's price action that often forms a triangle on a chart. And a technician will typically look for a breakout from that triangle or a breakdown. And the idea is that volatility is being pinched in, and you're seeing typically less volume as that triangle, that coil develops. But then when you see either the breakout or the breakdown, volume comes in and you see price trend in a certain direction for a period of time. So that's how the coil pattern and the triangle pattern typically works. And that's often what stocks do in general. They will have this impulse wave up or down, and then a period of consolidation or a corrective phase, which is a move in the opposite direction of the trend of larger degree. So those types of patterns are often continuation patterns. So if you see a stock that has gone up a lot in the last year, and now it's maybe entering one of those coils, well, the implication is the stock will break out to new highs as opposed to breaking down to lows. Of course, it could always break down, but you want one important thing to consider when looking at those corrective patterns like a coil is what the trend of larger degree is. Is it up or down? So it's always important as a technician and a trader to know what that is for the next move. So that's how that pattern works. Ultimately, though, I think keeping it simple with technical indicators is the best way to go. And nothing is more bullish than when a stock makes all-time highs, because there's no selling pressure above on the chart. When you enter new all-time highs, there's nobody looking to sell once the stock reaches a certain level. But when you have a chart that is going up into a prior range, well, you're going to encounter some selling resistance from those folks who had bought in that prior range. So the other indicator I would look at is things like all-time highs. That's probably your best bet when looking to find good liquid momentum stocks.
Any other tips that you would give to people who are either novice or probably more relevantly like intermediate investors who are trying to kind of figure out how to look at data in particular?
Yeah, well, I would say, going back to my last point, keep it simple. You can get really bogged down in all of these technical indicators and all the latest new ways of valuing securities on the fundamental side. Um, to me, when I look at price charts, all I have on there is price action. I don't look at moving averages very much. I don't look at a lot of the other, to me, complex uh, technical indicators. I simply look at what price is doing. If it's in an uptrend, that's a good sign to be long. If it's trending down, momentum is probably going to carry that lower in the near term. So I would say keep it simple. Find out what you're most comfortable with as a trader, and then you can kind of get a little more complex. So to novice or intermediate traders out there and technicians, I would say don't try to memorize all of the indicators out there. But what you want to do is um, focus on finding what works for you and keeping it simple.
When you're looking at just the price action, like what are you looking at in particular there? Because I think some people might look at these charts and not see anything in particular. Then there's different types of kind of charting analysis. There's like candlestick analysis, or then there's different time lengths as well. So for instance, I'll have somebody show me a time frame of an asset or a commodity, and I'll look at it, and then I'll just change the time frame, and I'll be like, well, now we're looking at a different picture here. So
Yeah.
what are you looking at when you're looking at just price?
Yeah, well, definitely, like you said, time frame is what is very important. I do look at candlesticks because I think they do tell an interesting story with regards to price action. You know, whether a stock is settling at the high of the day or the low of the day, I think is important, especially on a weekly picture. You know, how a stock closes on Friday to me is a little more important than how a stock closes on a Wednesday, for example, because you go into the weekend, you have more time, more things can happen. So conviction levels going into weekends to me is can be an important thing. So yeah, I do look at candlesticks, and it's a good technique I think on time frames is going big picture and then zooming in. So that is what I would recommend to a lot of technicians out there is look at a long-term chart and then go to a weekly chart and then a daily chart. And then if you're a short-term trader, an hourly chart or even a 1-minute chart. So start big, then zoom in near term. But ultimately, you want to know what your time frame is. For an investor who has a time frame of a holding period of a couple of weeks, there's not a whole lot of use in looking at a monthly chart over 20 years. But for a trader who tends to buy and hold stocks for years at a time, obviously that's when you would want to look at a longer term chart. So it's very dependent on what your time frame is because everyone is different. Every trader has a different time frame and they look at different indicators. So it really just comes down to what your risk management strategy is.
What's the biggest folly you see other traders make, or just investors generally when they look at data?
Well, data is definitely what do you mean by data? That's a very broad term these days. There's so much out there.
Yes, when they're looking at anything at all and claiming that it has relevance to the question at hand, the stock at hand.
Yeah. So I guess you just have to be careful to watch out for things like spurious correlations. The price of butter futures might be correlated to something that's going on in Asia, when in reality there's no actual correlation there. It's just, or there is a correlation, but they're not related. So things like spurious correlation can definitely be an issue for traders. So understanding if you see a relationship, is it a real one or just something that happens out of randomness? Traders and investors can often get fooled by randomness, to quote a popular book. So when it comes to data analysis, keeping in mind that there are spurious correlations out there and kind of running a check within yourself to see if a relationship makes intuitive sense, if it aligns with maybe behavioral factors, and if over a long period of time that relationship is held. Those are 3 things you could do to help determine if a relationship you see out there is something to rely upon going forward.
Any other tips for people as when it comes to analyzing price and price charts?
Yeah, I think the big thing is it's so cliche. There's so many cliches CMTs and all of us have, but the trend is your friend. Stocks that make all-time highs tend to go on to perform well. New highs tend to beget new highs, and vice versa. What's trending down in price action, tends to lead to more near-term pain. Over the long run, when you see the market has been down for 5-10 years, yeah, it makes sense to that the next 5 or 10 years may be good. But on a nearer term perspective, evidence shows that momentum definitely carries through over the next 6 months to a year. That what's been performing well may go on to perform well in the coming months. So I would say overarching theme is don't try to time inflections in the market. Rather, keep it simple and stick to that trend.
We've had the honor of sitting down today with Mike Zaccardi. He's an investment analyst and writer. You can find him on Twitter at twitter.com/Mike Zaccardi. That's Zaccardi. Thank you so much, Mike, for joining us today.
Thank you, Justin. My pleasure.
And thank you, everyone, for listening.